I would say, so, the Burr method, right? House hacking. I think that's always a great way. One of the things I've always said is, in my opinion, one of the fastest ways to make money in real estate is the fix and flip. So if you can find the single family home, you're going to live in it, or the duplex, you're going to live in it, fix it up while you live there. You're putting in all the sweat equity. Do as much work as you can.
You have found Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. We are locally underwritten by the Bank of Sun Prairie. Downloadable audio episodes can be found in the podcast link found at drawincustomers.com. And today we're welcoming / preparing to learn from Chris Gantz of Patriot Properties. We're going to be talking about property management. So Chris, how is it going today?
Good. Excited to be here.
Yeah, thanks for being on the show. I'm excited here because I've interviewed quite a few people in the real estate realm that are investors or real estate agents, things of that nature. I've never actually interviewed someone that has a business where they're actually doing the stuff that the people talk about.
Sure.
So there's investors, whatever, figuring out the money thing, but actually finding the tenants, getting rid of the tenants if you need to, the cleanup, the mop up, the mowing, the plowing, all that kind of stuff. Let's chat about that.
Yeah, absolutely.
So let's start with, what is Patriot Properties?
Yeah, so Patriot Properties, we are third-party management. We do a lot of management for our own portfolio. We have about 3,000 units across the state. We manage everything from multifamily being our bread and butter, self-storage facilities, mobile home parks, short-term rentals, Airbnb. Shout out Superhost. We got it again. Quarter descended. So
congrats.
We apparently there's a thing called like an ultimate host or something. So that's when you've gotten it 4 times in a row, like a full year in a row. So we have that now as well.
Wow.
It's like a new thing to Airbnb, so they haven't like given another badge for it, but internally we're like, hey, good job too. Yeah. Rock stars. So, but yeah, no, a lot of that is, shout out to the team that we work with, the people that we have on staff. It's not just me. So I can't take credit for everything they're doing. Really, I'm less involved in that side. That's the team that's running it. And so, and that's kind of an interesting point of like the operation side of like what we've built and what we've scaled to is what it looked like when we started versus where we are today. So yeah, as far as nutshell, property management, 3,000 units, state of Wisconsin. We're knocking on the door of Iowa. We've got ambitions to get over there, kind of expand into the Midwest in a bigger way. And so we always look at that as far as expansion, expanding our geographies toward Milwaukee, up, Fox Valley, Green Bay, eventually all of those areas. So right now we follow I-90, 94 kind of throughout the state, and that's been strategically kind of just happenstance, right? Our clients are like, okay, well, you guys are here, will you go here? Kind of just moving the line a little bit every time.
All right.
So
does that mean that you have employees in all these different spots?
Yeah. So what's interesting about the way that we operate is because we're a newer, younger company, there's a lot of benefit to, we don't have a lot of old ingrained habits because of the way things used to be done. And so with technology, the last 5 years, the last 10 years, there's been so much that's entered the space that we have a fully decentralized model, meaning we have an office in Waunakee. That's our only office. So there's no on-site office at any location, which is interesting because when we took properties over, there would be an office that was a converted apartment, was a space that could be converted to common area amenity. So we've done that, taking those units to re-amenitize them or put them back into the rental pool. And so day one, when we have a property like that, we're saving the cost of the unit, cost of the on-site salary. And so like that's typically very easy for us day one to pay for ourselves pretty quickly. So so that decentralized model, the way that works additionally is we have field staff. So our maintenance technicians in the field are all employees of Patriot Properties, our cleaning staff, double as showing agents. And then with the technology, we've also gotten set up with software like Show Mojo that lets us do self-showings 24/7.
Oh, nice. Okay.
So yeah, those are kind of the big differentiators, because when we look at the competition locally, even nationally, the self-showing piece is still in its infancy. So it's not something that renters strictly expect. Because we're doing it, people are like, whoa, this is amazing. I can just show up at 8 a.m. or 8 p.m. And the thing that we pride ourselves on, or the thing that we focus on, is how do we be the fastest, right? Because we can take Class B product and compete with Class A if we are just faster. And so we have the ability, or what we've done is, same day showing, same day application, processed by the end of the day, they get an answer that day. Whereas, if you call up competitors, we'll do this, we'll kind of audit, what's everybody else doing. And it's, hey, I want to see a showing. And it's, okay, we'll get you in this week, maybe. Or we've got an opening next week. And so it's a lot of times a week to 2 weeks just to see the apartment. By the time you submit that application, it's still another week to 2 weeks, depending on the level of capacity that the other competition has. But we've seen kind of that typical 2 to 3 week range of you see the apartment online, you want it, it's going to take you 2 to 3 weeks before you get an answer of, yep, you got a lease, you can take it. And so for us, we drive the urgency with our tenants of, legitimately, we only have so many of these units available, first come, first serve. So if you want it signed now, we're signing these units before anybody even has a chance to look at the other properties, which realistically, they might like them more, they might desire them more, but we also try to have a value alignment of, we're not trying to overcharge ridiculously. It's, what is this apartment worth? What is fair? And let's get that.
Yeah. I can see, it's interesting looking at the rental market around Madison, Wisconsin. Madison, Wisconsin, and the cities around. It's so interesting to look at the range. I'll look at a website like apartments.com and figure out, okay, 1 bedroom is this-ish, 2 bedroom is this-ish. But you're talking like a 30 to 40% swing in what the ish part is.
Oh, yeah.
And I don't necessarily see why. I take it back. I understand why, but when I see a low end versus high end, to me, outsider looking in, it's not necessarily obvious. Like, oh, this is way better features or better parking or something, or it looks nicer, it's newer.
Yeah.
It doesn't always seem to be the case. It's kind of like we pulled this number straight out of our butt.
Oh, yeah.
And they pulled this number straight out of their butt, and maybe it's good, maybe it's not.
Well, it's interesting. It's interesting you say that, because there isn't necessarily a conventional wisdom that permeates the pricing in the market, right? And so what we do and what we've done is we have defined a strategy of how do we price the units. And like, very simple way to boil it down is, what is the median income for that market? So let's say Madison, Wisconsin, if we can get data boiled down to a neighborhood, we'll use that. But let's say Madison, Wisconsin, median income is $70,000, whatever it might be. And so we'll take that. We know our qualification standards. So 1/3 of your rent, right, or 1/3 of your income can be used to qualify for rent. And so if we're backing that out, let's say 100,000, just for easy round numbers, you can use, divide by, let's say 120, that'll make it easier.
Sure.
Divide by 12. So you have, what is that? 10 per month, 10,000 a month, right?
Yeah,
rough
sure.
Number. So
Right,
120
right.
a year, 10,000 a month
Okay,
is
yep.
your income. So you can rent up to $3,300, right? That's
Gotcha.
what you qualify for.
Okay.
And so that's the way that we'll price averages. So 2-bed, 2-bath is what we peg that household income against. And then 1-bed, 1-bath, obviously individual. And so we price that way. You see all of the other people in the market, especially the mom and pops, where they're pricing reactively to what everybody else in the market is doing. And so sometimes they're good and they're watching the market and they're like, oh, these guys are charging $3,300 for this Class A 2-bed, 2-bath. Great. We're going to price, discount our vintage to this and figure out our price. But what's more common is you get the mom and pops, the older operators, that they're like, this is just the price we've always charged. And so that's why we're charging. So that's where you get that big 30% swing where somebody's like, well, I'm getting $1,100. I used to get $900 and I'm happy. But the market supports that unit getting $1,400.
All right.
So it's I would say it's a lack of, not to say a lack of education, but it's a lack of capacity on the self-managers to be able to be that active. That's one of the big things, that's one of the things we tell people when we onboard with them all the time is, we're an active manager. This isn't just a passive investment anymore. We're going to run this every day. And so we'll look at, full portfolio every 2 weeks. What are the rent levels at every single property we have? What renewals are coming up? What's eligible? So that we're constantly moving the needle forward for our clients. And a huge part of that is, inflation's been out of control, right? Everybody's aware of that. And so we had an insurance quote, renewal 20%, right? And it's like, okay, if the expense on the insurance is going up 20%, we have to keep up, right?
Yeah, that money's got to come from somewhere.
Yeah. And so that's a piece too, is that active, knowing the expenses are going up, how much are they going up, and then what is the level that we can, combat that through the revenue growth and, keep on track. And when we do these increases, we try to, if somebody's going to go up a significant dollar amount, we don't just want to raise the rent. We want to try to be able to give something for it as well. So we have properties, Canterbury and Sun Prairie here, for example. We'd raise the rent over time, got enough additional cash flow that we could support putting in amenity space. So we added a gymnasium. We have plans to add a dog park, outdoor grilling station, patios, that kind of thing. And so that's where we're always, back to the concept of how do you get Class C to compete with Class A, right? The new development. We always look at these turns of, well, what's the next thing we can additionally, put into the unit to make it a little bit better to get it to compete. And so I think there are other operators in the market that do that and do that well, but it's not necessarily the common sentiment. Broadly, I would say nationally too, because you still have, what I say is real estate's still an old man's game, right?
All right.
So you get a lot of these guys that, a lot of it comes down to risk tolerance, right? When you get to be 60 years old, 70 years old, you've done a really good job of building your portfolio. Now, main goal is protection, right? How do I keep what I've built? And so, ironically, these guys have the most capacity they've ever had. They have the best loan to values they've ever had. They have the best cash flow they've ever had. But they also are used to doing things the way that they've always done them. So they don't necessarily take that risk, so to speak, of, well, let's put the amenities in, let's raise the rent a little bit. That's where you also see that keeps the market down, right? Or that's where you also get that 30%, 40% variance in, well, what's this guy charging versus what's everybody else charging, because they don't need it. Not to say that they don't want it, but they're like, I'm happy with what I have.
Too lazy to get it.
For lack of a better words, right? It's, you talk to these guys and they'll be like, no, we're the hardest workers. And they are. Obviously, they've built a good portfolio to where they are. But I think a lot of the sentiment there is it's just they don't want to, they think of that as, well, it's just going to end up being another headache, right? Now I'm going to have turnover. Now I'm going to have, I'm going to have to do the work to solve for that problem. So I'd say that's kind of where that disparity comes from, is it ultimately comes down to just, there's a wide range of operation where you have the mom and pop, you have the gray stars of the world where, huge company with great, big, robust processes in place. And then you get, everybody in between. And so that's what's interesting is it's, a 4 unit's a 4 unit, an 8 unit's an 8 unit, but so much of it comes down to the success of that investment rides on the operation, right? You could fail, right? If you do nothing and don't show up, it's going to fail, right? If you put a lot of, sweat equity, thought, whatever, effort into it, it's almost impossible to fail. And one of the things I remember Matt Pacini said this, and Matt Pacini's a good friend of Cody Wiseman, local to the Sun Prairie market. He always said you can't lose money in real estate if you never have to sell, right? And so,
sure, right.
So that's,
over the course of time,
yeah,
you can't help but make money.
Yeah, you might get beat by the market, maybe, but if you never have to sell, you'll be just all right.
As long as your runway is decades long, there's no failing.
Well, because you also have debt pay down over time, so it should be getting better. You have appreciation, you have depreciation, right? You have all these benefits intangibly. When that's unique to real estate too, is like you have these 4 intangible income streams, right? You have the cash flow from rent, but then you have those additional things that, if everyone says buy it, right? That's where you make your money. But if you do that, it's if you put any level of effort into it, it's very hard to mess it up.
Fair, totally fair. Yeah, it's interesting. I've been looking at properties, and I look at them as businesses. So I'm looking at ones that cash flow. Mm-hmm. And I look at them, I'm like, how can you price your business, essentially this property, at a rate where you're not making money or you're negative cash flow.
Yeah.
I would never buy a business that's not making money
Yeah.
unless it had something, a reasoning for that.
Yeah.
On the flip side, I guess you look at Amazon.
Yeah.
Well, 5 years ago, they were losing money left and right, and people still invested. So,
well, it is crazy because it is, we've come to realize that there are different types of markets, right? There's the cash flow markets, there's the appreciating markets, and Madison is certainly more of that appreciation model where you get a lot of these guys that'll come in and buy, and they're like, yeah, I know I don't cash flow day one, but there's upside on the rents. And the crazy thing with real estate is you'll get buyers that have significantly different criteria, right? So you get the 1031 buyer, they're like, I need an exchange, so I'm okay paying more because I'm avoiding this much in tax. And so there are a lot of people that when they look at it, they're like, oh, I'm going to get this depreciation value. I'll cost seg it. I'll accelerate depreciation. Now 100% bonus depreciation is back, right? So that's a significant part of a lot of people's strategy. So that's where you see these guys that are buying in Madison. You're like, how does that make sense, right? And for us, we're generally very principled on we only buy if we have a 5% cash flow, and we want upside if we can, but that's so hard to find, right?
Very, very hard to find. In this area, this market, yeah.
Well, especially in Dane County. But that's where, like, you look at other markets that exist. And so we, again, following I-90-94, you get markets like Lake Mills, like Cottage Grove, Fort Atkinson, some of those kind of between Milwaukee, Madison markets that are becoming very strong where you can get cash flow, but they also will have appreciation because Milwaukee and Madison continue to grow toward each other.
Yeah.
You get, Cottage Grove with the Amazon distribution center. There's all of those kind of big macroeconomic things that are happening. And so you can find some of those kind of secondary tertiaries, or, I mentioned like knocking on the door of Iowa. We look at Dubuque, Iowa, and if you look nationally, rent growth charts, Madison, Milwaukee, two of the hottest rent growth markets in America. We have like the eastern quarter of Dubuque or of Iowa in general, so Dubuque, Davenport, kind of following the Mississippi down, and they had virtually no rent growth, but everybody there is making as much money. So like Davenport, Iowa, the median income for Davenport is pretty close to Madison, and so like by that metric, the rents should be the same. But if you look at what are actually, what are the actual rents achieved, there's a significant discount in Davenport. There's a significant discount in Dubuque and, in Iowa at Mass. And so a lot of that, maybe it comes down to it's just not a sexy market.
Sure, it's Iowa.
Yeah, and so it's, but like that's where the best deals are, right? Because like you want to go buy somewhere sexy like San Francisco, like you're not getting cash flow or appreciation, right? You're just hoping and dreaming, right? And so
just so you can tell people you own property in San Francisco.
Yeah, it's and I think that we're seeing that bleed over where Madison, Wisconsin, the Midwest is becoming very desirable nationally. So you're seeing East Coast, West Coast institutional money compete for some of these, larger deals that come to market in Madison, and that obviously drives the price and the appreciation, as to be expected, but it's, so that's one of the things that we're always looking at is like, how can you find those off-market pocket listings? What, is out there? Because there are deals to be had. You just have to find them before they hit the MLS, right? Before they hit the market, before a broker gets to it. Because like you can price everything on comp, and based on comp, everything, is priced to the moon. And so, if you can find that reasonable seller that, okay, we can avoid these realtor fees here, do it direct, we're going to make this a very easy closing for you. We've had some success with that. And fortunately, like with our network, because we manage third party, we have a ton of people that are brokers. We have a ton of people that are contractors. They're very ingrained in this industry where, it all kind of works together. So say a contractor's doing a roof and they talk to the owner and the owner's like, oh, I'm done, right? I don't want to do this anymore, right? And, their response is, well, I know a guy, right? And so that's, for us, that's been a huge strategic benefit, is just relying on our network, relying on the people that we work with as clients or that we work with as vendors, and, seeing source there.
So how typical Joe that wants to get in the real estate world, So they've been listening to this incredible podcast,
Yeah,
right?
yeah.
And they hear all these investors are like, deals are out there, whatever.
Yeah.
Where would be the best place or a few places for them to start to try to find these deals?
I would say, so, the Burr method, right? House hacking. I think that's always a great way. One of the things I've always said is, in my opinion, one of the fastest ways to make money in real estate is the fix and flip. So if you can find the single family home, you're going to live in it, or the duplex, you're going to live in it, fix it up while you live there. You're putting in all the sweat equity. Do as much work as you can. And so that means learn how to swing a hammer, learn what you can. YouTube's a great resource. That's largely how we got into it. My wife and I, first house, bought a 100-year-old farmhouse, fixed it up, added a bathroom, did a lot of education through School of Hard Knocks, right?
All right.
And so I think that's a huge thing is kind of back to the point of if you put effort in, you can't fail. Do your research, obviously, on the front end. But I think there's I would say, generally speaking, there's a large lack of confidence that people have. And the first deal is the hardest, right? Because once you do that first one, whether it's a duplex, a fourplex, an 8-unit, once you have it and you go through the process and let's say you put 3% down, you put 20% down, whatever your means are to be able to do it, you have the money to put into the repairs. Say you buy a house for $200 and you eventually sell it for $300. Maybe you put sweat equity of $40,000 in. Well, you just made $60,000, right? And so you still have your day job. You made what you made, but you make $60,000. And for us at the time, it's like, well, shoot, I made what I would have made working full time
right.
on doing this house. And so that's kind of one of the first aha moments. And then the other huge one is for like a 4-unit, for example, is you get it. There is upside. You can push the rents, and you go from, let's say, $1,000 to $1,200. Well, you do that. The bank comes back and they're like, okay, we agree this is worth more, arguably 20% more because you raised the rent 20%. And so you go to the bank, you put 20% down. They're saying it's valued at 20% more. They essentially give you your down payment back. So now you're in that property free and clear, right? Well, not free and clear, but without any of your own capital in.
Gotcha.
And
so the zero cash investment essentially with that little bit of arbitrage.
Yeah. And so if you can do that, obviously you have to be able to support the additional cash flow of, pulling your equity back out for that mortgage. But if you can do that, that's the scale, right? That's the model that's repeatable. And so, making sure you don't want to pull it all out and be like, well, I know I have a roof coming, but I just pulled it all out to go buy another one and now I don't have money for the roof. Like, don't do that, right?
Right.
But I think a huge thing is it's tough to say, like, finding that first deal, the duplex or the fourplex, that's definitely the most competitive market, right? Because that's where everyone's starting. You still have the guys that are in it and have experience in it that will still look at those deals. So if there's a good 4-unit, they're like, wow, this makes all the sense. The seasoned investor is going to snatch it up, right? They're going to be quick with it. And so it's tough to say, it's to find that first deal, it's probably not going to be that grand slam. It's not going to be 10% cash on cash day one and all the upside. But if you are able to, back to the house hacking model, if you can do it where you're like, I can break even just on this first one, even where I'm not paying rent anymore because I'm paying myself essentially, but I know I'll get that forced appreciation. I know I'll get that sweat equity from it. I would say that's the most sure way to get started. And then once you have that first sale, right, you sell that house the first time to go get that duplex, fourplex, next build. Well, now you have capital. And once you get the capital, that's where the game of real estate gets different. Not to say easier, but now you have capacity. And now you can go and you can do the 8-unit, the 16. And once you get into those markets, 16, 24, 50, I would say between 24 to 100, there's a really small, I shouldn't say really small, but there is a significantly smaller pool of competition. So roughly, like if you look in the Madison market, there's probably, let's say 100 guys or less that are dealing in that space.
Okay.
And so it's no longer, look at the Madison market is billions of dollars worth of real estate. So you have thousands of people looking at those duplexes, fourplexes, if not hundreds of thousands of, it's definitely brings it to a more math-based purchase, right? So with the duplexes and fourplexes, it's tough because you have comp base, right? So based on income, you're like, well, it's not worth this, but based on comp, people are selling their houses, single family homes for this. People are selling, their duplexes, price per unit. So that price per unit model gets more important from that 1 to 4 unit range. Well, once you break up into that 8, 16 units, that's when it starts to become truly cash flow based, where it's, okay, now the bank looks at it and they know you're not going to live there, right? And so now it is truly more of an asset, right? More of a passive investment, where it is, what does the cash flow support, assuming I'm not living there, right? Assuming I'm not getting to save on the rent. So I can't just have it break even. It has to do a little bit more.
So do they, with a bank like that, do they ask for more money then? A bigger deposit beyond the 20% to try to make up that difference?
For like which purchase?
So let's just say you got a property for numbers. Let's just say $1 million, and it's bringing in enough cash to justify, I don't know, $850,000 or something like
Sure.
that. You normally put 20% down, but you already ate up 15% in your lack of cash flow.
Yeah. I would say if you get essentially their appraisal gap, right? So if it appraises at, let's say, $800,000, and you're looking at the purchase price of $1 million, generally the bank will require the 20% down on the $800,000 value.
All right.
And then whatever the gap is, they're like, and you have to fill that.
Got
so
it.
They're not necessarily looking at, well, you bought another $200,000, that's another X percent down. They're looking at that of, well, you're, call it overpaying, right? For lack of better words, of you're overpaying by $200,000. And so it's an interesting game. I mean, in today's market, if you get an appraisal, I've heard of so few people that the appraisals aren't coming through.
Oh, interesting.
Because it's again, back to the comp base, it's almost always that the appraiser, first of all, they know what the number is, right, as far as what's on the purchase document.
Do they really?
A lot of times they do, or they can figure it out.
Okay.
They can go and look like, hey, what's it listed for? So, okay, let's assume that they offer full price, right? So that's kind of, not to say that that's what they're pegging it to. They just go on Realtor and they're like, oh, it's appraised at what it's asking, right? They'll
sure.
They'll do
Happen
their
to be
analysis.
exactly, right?
Yeah. Oh, yeah. Well, yeah. They're like $1 more. But it is surprising, like, how often that, they get so close to the number. So it's typically never below. I mean, in the last 5 years, it's been really rare to hear, oh, it underappraised by 5, 10, 50 grand. And so that person has to come to the table. It's almost always you're seeing people that they're like, oh, I got 5, 10, 50 grand, to the positive, where now instead of me having to come to 20% to the table, the bank will let you come with 19% because they're like, okay, you're paying $800,000, but it's worth $1 million, right? Based on an appraisal basis. So if you do it that way, ultimately it's loan to value, right? And they're like, we're taking not the purchase price, but what is the appraisal as the value?
Got it. The appraisal game just seems so interesting to me, and I guess we're going down a rabbit hole here, but it's curious to me because I guess I lived through the 2008 and all that kind of stuff, and I remember fixing a printer back when I had my printer repair.
Yeah.
At a mortgage company, that they were printing W-2s.
Yeah.
And I'm like, that's an interesting thing,
interesting choice, right?
That their little dot matrix printer with the pre-printed W-2 thing. Where just, how much do you need to make this loan? Right?
Oh, yeah.
It was an interesting game.
Yeah.
So I'm like, how would you be an appraiser back then?
Yeah.
And I wonder, like, well, Zillow and Redfin and all these guys, they're essentially using software to appraise it. What do they call the Redfin estimate or something like that?
Oh, like the Zillow's Zestimate.
Zestimate.
Yeah.
There you go. Yeah. Where they're just pulling stuff.
Yeah.
So do you see appraisers, I guess, 10 years down the road? Are they still going to be a thing?
I would say it's, I think it'll look a lot different. It's always tough to say, like, oh, this industry is going to be gone.
Right.
Because there is a value to the product they're putting out. But to the point of who has the most data, right? Who can tell you the best number? CoStar, right? Apartments.com. I believe that's part of their strategy, right? They've been doing what they've been doing in rental space, but they just started Homes.com, right? And so they started that not because they wanted to sell a bunch of homes or sell a bunch of ad space on Homes.com. They wanted the data of what are homes selling for. Let's tap into the MLS. And now, and their model is to make CoStar specifically, the analytics product, the best it can be. And so, and like you look at the people that use it, it's Greystar, it's Hines, it's all the national companies, and it's the biggest players in the local markets, right? And so the value there is for them to, use that CoStar data. It's here's what's really achieved, right? Here's the real numbers. So like we say, we're basing off of what's median incomes, right? We can tie to here's what we think is possible. But then if you look at CoStar's data, they're like, here's what's actually being achieved. And there probably is going to be a gap between the median income to like what's actually achieved in every market, because you're always going to be playing catch up, right? You're always going to be chasing it. But I think that's as far as like, is the appraiser individually going to go away? I think that you'll see, I would say brokers and realtors as sales positions significantly different, and call it evolution, where if you look at a broker today versus a broker 50 years ago, well, the value of the broker 50 years ago was, I have an office that people physically come into because they tell me they want to sell their house, and I know where the houses are being sold, and only I know, right? Well, now you have the democratization of that MLS book, right? So that value is completely gone for the broker because everybody can see, everybody everywhere at all times. And so I think, it's kind of looking at it, that concept of like, well, if the appraiser isn't doing strictly what they're doing today, what can they do better in their service? So maybe they take this estimate, but maybe also now they're running their own projections and like, hey, we're running this on a higher level of data. Here's a better appraisal. And so it's not just based on comp. It's not just like, now maybe they're diving into here's what is actually potential, and then give option ABC. Hey, if this buyer is going to buy it to break even, here's what it's worth. This buyer is going to buy it to put $200,000 in, and they have a history of that, looking at, give that to the underwriter. Okay, it could be worth this, right? So like maybe they get a tiered level of confidence, call it, where, okay, if you're the bank, how do you know the buyer? How well do you know them? What did they say they're going to do? So I think it could be a better tool for the buyers out there of, well, now you have more data. The bank has more data. We all have more comfort in what this can be. And so I don't necessarily think it'll strictly go away, but I think it'll be drastically different just based on like all the stuff that AI, the new technologies have that's out there. And again, just the access that everybody has to all of this different information.
Yeah, I mean, the Redfins, the Zillow, Trulia, all these things are, I mean, what are we talking, the last 3-4 years?
Oh, yeah.
That changed the game incredibly.
Oh, it's insane. I mean, even like looking at AI, so for us, for like the company we are today versus the company where we were 5 years ago, or the company we were even a year ago, 3 months ago, is drastically different because there's constantly new technologies. And so, like, for example, we started day one, AppFolio was the only thing we had. So that was, AppFolio, our project management software. And they have, good resources built within their systems that you can solve for the basics. But then they've, done their integrations, their stack partners, and they have people that specialize in the showing softwares, in the data, in the accounting softwares, in the property maintenance softwares. And so we've tied a lot of those in, and we've seen significant efficiencies in that, where it's saving time, saving costs, saving across the board, where back to the point of velocity, where the metrics we base off of is how quickly can we have a tenant move out, get the unit turned over to a really high quality level, not just turn and burn, hey, you're out, you're in. We still want to make sure that, highest value concept is there, as you're getting, fresh paint, clean walls, clean unit, new floors if it needs it. So it's not, here's this unit that's been rented continually for the last 30 years with no updates ever, to keep them up to date, up to market, and to be able to remain competitive. And so I think that, watching that technology, it's who we are today is going to be drastically different than what our company looks like 3 months, 6 months, 12 months from now as well.
Sure. Fair. I want to shift more into the property management side. Mm-hmm. Because it's interesting, because you talk to these real estate investors and they're like, stick money in, get money out, rinse, repeat. Yeah, everything's magical. But then as you dig into it, you're like, who shovels? Mm-hmm. Who is mowing? Mm-hmm. And if the furnace breaks, what happens? Do we have a furnace guy? Mm-hmm. Or are we trying to call every HVAC company in the world until somebody answers the phone? Yeah. Like, tell me about the bare bones. Somebody gets a rental spot. Yeah. They hire you guys. They got Patriot properties, right? Best in the biz.
Yeah.
And day one, how do you figure out let's just take care of the simple maintenance right on duplex or fourplex.
Yeah.
Maybe not fourplex. Let's start with duplex.
Sure.
You got mowing, and in the case of Wisconsin Midwest,
Yeah.
you got shoveling and all that kind of stuff.
Yeah.
Who's taking care of that?
So I'd say what we typically pitch to people when they come in is we can have our investors and our clients be as involved or as removed in the process as they want to be. So I always like to use two examples. We have younger guy has been building a massive portfolio, very active in finding deals, very active in doing the turns. So he'll coordinate a team that he's doing his own flips, right? He's like, I'm going to go do the flooring. I'll do the cabinets. I'll let you guys know when it's ready to post. And then we'll come in and get the photos and do your thing. Then we have the guy that's, 80 years old, has owned this property forever. And we, send him his monthly reports. We send him a quarterly update. And he's like, oh, I forgot I had that. It's like, that's nice. Where we all want to be, right?
Yeah,
that's the goal.
That's a good place.
And so we have that capacity to be 100% turnkey passive. We can pay the mortgage, pay the taxes, pay the insurance, handle, if claims come up, evictions, whatever, anything that could possibly happen, we can handle it. And so that's where when we have these conversations with clients on the front end, we do somewhat of like a fact finder conversation where it is, what are your goals, right? Here are the pointed questions. How important is cash flow to you? How important is appreciation? What do you want to do? Do you want this one property to be retirement? Do you want to grow this thing and have this property buy your next one and your next one and your next one? And so everybody's different, right? And so that's one of the wild things about the third-party management side is you're not only managing the properties, but you're also managing the people and all these various processes. And so I say that's the start of the conversation, right? Is what are you guys looking for? What do you want out of this? And then from there, we can have more pointed conversations of the strategies and goals to achieve that.
All right. So in the case of, let's just take mowing as an example.
Yeah.
So if I'm going to say the landlord.
Yeah.
The landlord takes care of mowing, whether that's through third party or they hire Joe Bob's landscaping service, whatever.
Yeah.
Versus if the tenant takes care of the mowing.
Yep.
Do you see a substantial or equal or any rent difference at all?
Yeah. So the duplexes and the single family are treated a little bit differently than like the 4s and above. And so the 4 units and above, typically that's all contracted, right? That's all vended. And so we have a lot of staff in-house that say we do about 90% of our work orders. What we don't do is the technical side. So the plumbing repair, the electrical repair, the HVAC, we have good vendor relations for all of those things. But as far as when it comes down to like the duplex and the single family, it's two models. Like what's conventional is the tenant takes care of their own. So the tenant buys a mower, does their lawn, they shovel in the winter, they're liable. The biggest point of, when it comes down to like snow removal and some of those things is liability, right? So as long as they know and we agree and it's in your lease that you're taking care of it, then if you slip and you fall, well, you didn't take care of it, right? And so
got it. Okay.
So that's a big piece that we're looking at in the back end, right? Is how do we always cover for risk, right? But as far as the other options of what's a little bit newer and less conventional is we call it a one bill system. So everybody, you see the people out there that get nickeled and dimed. Look at Airbnb recently did an update where they had the base fees and then they had all the hidden fees, cleaning fees, host fees.
Oh my gosh, that's insane.
Yeah. And
to the point that it's more than a hotel.
Oh yeah. Well, and people hate that, right? Because they're like, oh, I can get this unit for $100 a night. And then they book and it's like $300.
Yeah. Did we say 100? We had 500.
Yeah. They're like, oh, the room is 100, but here's all the services that you're paying for.
Yeah.
And so that's one of the things that we've seen even in the apartment side, that people like that one predictable bill. And so with some of the single families, some of the duplexes, we'll tell them, hey, we're going to do the lawn care because now you don't have to buy a mower. We don't have to follow up with you when your neighbor does their side, but you didn't do yours. And then the city calls us. And so we have some of that where we'll do it. And like the other thing with those is like the trim in the landscape. And so some of our owners that have beautiful landscaping on a single family home, they're like, I've maintained it forever. This is, my pride and joy. I'm moving out of state, but I want the landscape to remain really high quality. Guarantee this tenant's not going to take care of it the same way, right? And so we'll let them know, okay, we can get a contractor out here, let's call it $100 a month, whatever it might be, to at least maintain it to a decent level. And so, again, that kind of comes back to the conversations on the front end with these owners of what is important to you guys, what is the bare minimum level that we should operate at, and then somewhat in the market too of like what can we offer that makes us a little more competitive. And so like in Madison, most people are doing their own mowing. Most people are doing a lot of their own stuff. And, you know, it's not to say our generations are getting lazier, right? But
that's safe to say.
Well, the access to luxury, let's call it, is you've got Lazy Bones Laundry, you've got Grubhub, you've got Uber, all of this.
Yeah,
so,
the groceries to your door.
Well, yeah. So if you're the type of person that's willing to pay Jimmy John's to come and deliver a sandwich, you definitely don't want to mow your lawn, right? I mean,
you want me to walk how many steps?
Yeah,
Whoa.
yeah. You're like, and now I have to buy a mower, and so you know, we'll price for that, right? So we'll say, okay, we're taking care of the lawn. You're paying $100 more than you would, right? Or $200, and so we'll have a price differential, and we actually have some properties where we'll do all utilities included because we have enough historical data where we know, okay, here is high usage, most that they could have in an average month. And so water, sewer, gas, all of it's included. And we've actually seen we can cover for the expense and then have a little bit on top because essentially it's an admin fee, right?
Right.
You only have to pay us. You don't have to pay gas. You don't have to pay another bill for electric. You don't have to pay all these other things. It's just pay us and we'll take care of it. And so that's something we've seen internally that's been really successful and that the market wants, right? The renter base likes to have that.
It's just simplicity, which people love that.
Yeah. Oh, yeah.
So, I mean, myself included. So, I
Yeah.
get that one check or one pull every month. I know what it's going to be. It's
Yeah.
flat. I don't have to be like, oh, it's cold out or it's 90 degrees out. So
Yeah.
my electric bill's whatever.
Yeah.
So it's easier to budget for.
Well,
so,
it's also interesting to that point. You end up with a higher quality of living because sure you might be paying more, but you're not conscious of, well, I'm going to turn the AC off because I don't want to run the AC. And so we went through a property recently and 56 units north side of Madison and kind of an older renter base, 1960s builds. And so you go in, it's like 90 degrees, right, outside. And they're, maybe the window's open, but they don't have fans, they don't have ACs because they're so conscious of, well, I don't want to run the AC because of this. And they can probably all more than afford it. It's more so just ingrained in their habits of, well, I've always done this, right? I've always turned the AC off. And it's
they've lived through that period of time where
it
wasn't ideal.
But
or they're conscious of bigger world things, I guess, that can happen.
Yeah.
From that. So, yeah.
But it's like if you did run it, how much more comfortable would you be, right? And like if you are more comfortable, what is your quality of life? And so that's kind of our philosophy around it of like how do we, have that baseline of service of value that people use the units in the way they should be used, right? Don't underutilize it. Use it for what it's meant for. Because like the other thing is if people aren't running the AC, it's meant to be run, right?
Yeah, use it or lose it.
Well, so yeah, you end up, that tenant lives there for a year, 2 years, never turn on the AC. In theory, you'd be like, oh, it's a brand new AC. But because it hasn't been run for 2 years, you turn it on in year 3 and it's like, well, this just doesn't work now.
Yeah, the bearings are rusted.
Yeah. So it's there's a lot to be said for having the occupancy to have that maintenance because then you always have that person that will let you know if there's a problem. And that's one of the things that's an interesting point to make too is, other companies, there's chargebacks for basic maintenance. Obviously, if you punch a hole through the wall because you just wanted to, we're going to charge you back, right? But like the things like the AC repair in our lease, it's, hey, we told you there's an AC, it's broken, it's our cost, right? It's the owner's cost. The property's going to cover this because it's in your lease, it's here. And so that's one of the things, especially with let's say the older generations, is they have that fear because maybe that was the convention in the past of, well, we're going to charge everybody back for everything, regardless of whether or not it's
charging the tenant back.
Yeah.
Oh,
yeah.
interesting.
A lot of people used to do that, right? And so it's less common today, but you still get that mentality where people are afraid to put in work orders because they're like, well, I don't want my rent to go up. I don't want this, that, or the other, right? And so Whereas for us, it's like, let us know, right? If there's a problem, let us know as soon as possible because we want to maintain it. We don't want you to have this issue that's small today become a bigger thing tomorrow.
Right. I didn't tell you the water softener was broken and therefore
Yeah,
every water appliance is now destroyed.
Exactly.
Interesting. Tell me a story about tenants, because that's always kind of a thing that seems to be overlooked.
Yeah.
I've had a friend who had, I think, a boyfriend of a tenant kill himself in an apartment.
Oh, geez.
And so she got out of it. She's like, I don't want to deal with this.
It's one way.
Yeah, right. And just things like that. I've gone into places that, I guess it always makes me think, like, I didn't know people would live this bad.
Yeah. It's shocking.
I mean, disgusting.
Yeah.
Or so much junk, or 50 cats, or just
the
smell of whatever.
Oh, yeah.
Not to say everybody's like that. It's just one of those, like, oh, this would be embarrassing to own.
Oh, yeah. It's, I would say, so, like, a lot of times we see this on the acquisition side because for us, like, there's a high standard of the qualification. And so over time, you turn that tenant base and you're, again, giving value. So you're getting value. Kind of the, let's say, respect gets respect, right? So if they respect their apartment, we take care of it. We know they're going to take care of it. And so you get a result there. So I'd say the crazy stories when we fill are more so just people can be crazy. But like the crazy stories on acquisition is you go in and, the hoarder stories, the people that haven't cleaned in forever. And so a lot of times on the walkthroughs, when we're doing these walkthroughs at acquisition, like one of the rules that we have on the team is just more so an unwritten rule is don't open the fridge, right? So as you just
like, trust.
Yeah, you do that and you just get hit with this wave and you're like, all right, I'm out of here. So I'd say there's so many stories that we always joke in our office where like all of our retirement plan is we're just going to put it all together in a book, go to Netflix and try to sell a TV show because it's just insanity. But one of the recent ones that was funny, we had a tenant, I have no idea why they did it, but they had written poo-poo on the wall and we're like, that's weird, right? And then we realized it was actually art because, the medium they used was poo, right? And so we joked, we're like, we need to go cut that out and frame it, airtight, sealed, but like this guy's an artist, right? This guy's on another level. And so there's things like that. We've had properties where, again, buying at the acquisition, we've done a lot of value add syndication where you're buying the worst property in the best neighborhood. And so one of them, we had, active drug dealing, weapon brandishing, SWAT was showing up, and dog fights, right? So like all four of those things were happening at this property. And that's the type of thing, like you can't know that necessarily when you're going through your due diligence.
They didn't put that in the inspection report?
Yeah, I mean,
SWAT shows up weekly.
Oh, yeah, you can look at the police reports and like, okay, high level, but like a lot of that stuff, sometimes it's like it doesn't actually result in a true charge, so you don't get a report, right? It's like the police showed up, but not like they showed up and they're like, hey, this thing's happening, but it's not enough to do the paperwork. And so that's one of the things that we've gotten significantly better on our due diligence is plan for that. No, like when we go and walk, get better notes of the tenants when you're walking through the units. There are tells, right? There are giveaways, but that goes to the point of like we're walking every single unit, right? And so I can't imagine. There are some people that, you hear they'll buy a property and they see 3 of the units and that's what they see and they buy. And then it's like, oh, I didn't know the other 80 were this. And so I would say that's how we avoid some of that. But it's, yeah, as far as the story side, we probably spend hours on all the craziness that you see in all, varying types of ways. And one of the things I always kind of sum it up to is it's people live in these apartments and it's their home and it's their most comfortable place, right? So they let down their guard and they'll be who they are, right? And some people, like most people, I would say on average are great people, but some people are just crazy.
Sure, fair. Yeah, it always makes me wonder when I'm looking at these places. And maybe it's because I think like, oh, here's a deal. Yeah. And you walk into it and you're like, oh, yeah, no.
Yeah. Oh, yeah.
If this was $1, I wouldn't buy this.
Oh yeah, yeah. There are it's that exists for sure, and it's we've seen a couple of those where it's like you would have to pay me and I'd still be hesitant.
Yeah.
And, I mean, over time we've gotten better. A lot of that comes to capacity, right? It's like we have bigger teams that can handle more, so that buy box has gotten bigger, so to speak, so we can say no less often. But there's still plenty of times where like, yeah, this is this is a dumpster fire. Like, do we want to do this?
All right. We don't have a ton of time, Chris, but I want to touch on a little thing. As a landlord, so I get a property, whatever, and I'm hiring a property manager. I've heard of people, a lot of the people that are on the show, they're talking about getting properties way across the country.
Sure.
Sight unseen. So they're trusting their broker or property manager or something like that. Well, I guess let me back up a step. One guy mentioned, he said, first you find a property manager, then you find the property.
Yeah.
But I'm like, you're talking about finding a property manager 4 states away.
Yeah.
How do you vet a property manager?
Yeah, I would say so we actually have clients that are out of state. So we've gone through this process with them, and for us, it's expectation management, right? And for them, it comes back to that conversation on the front end, that fact finding. What are your goals? What are you going to do? What do you want? What are you looking for? And so for us, we try to show our value very quickly right out of the gate. So for example, this week we had a couple out of California. They have a 4-unit that they are under contract in Milwaukee. And they're like, all we know is what we've seen on Redfin. So we looked it up.
Like 12 pictures.
Yeah, 5.
Half out of focus. 5.
Yeah.
5 pictures.
Even better.
We don't want to run out of film.
Oh, yeah. And so, they're running off of projection. And they are in the real estate industry. So they, I would say, are more educated than the average person in the sense that they have a reason to have more comfort with like what they believe. And so they call us and they're like, we know this sounds crazy because we haven't seen this. We're under contract. We haven't seen photos of the insides. And so they have a couple of local connections. They're from this area, right? Lived in Wisconsin, moved out to California. So dad, brother, friend, whatever it is, they're like, this guy's going to go walk this for us and he'll take some pictures, some photos, and give us his opinion. And so what we'll do in that situation, what we did is we sent somebody from our team. We're like, we'll also get the photos, the videos. We'll do a check sheet for each unit. And then we'll highlight, SWOT analysis, right? Strengths, weakness, opportunity, threats, all of that. And so that's how we start the relationship. And obviously when you do one, you get the next one and grow, then that relationship is there, right? But I'd say the big thing on the front end for us is it comes back to that expectation management of here is what we are capable of, right? Here are the technologies we use. Here are the processes we have. Here's, we'll give a blank copy of the lease, read through all 50 pages if you want, right? And ask us as many questions as you want. Because for us, communication's huge, right? We'd much rather work with the people that call us all the time and tell us what they want, call it, squeaky wheel, versus us assuming we're doing the right thing. And on paper, valuation's going up, everything is great. And then you get a phone call with this person on an annual review and they're like, well, I'm mad about this. It might be a super minor thing. Like, well, I saw the light bulbs are outside, when I drove past last week. And maybe it was an oversight, right? But it's like that little detail is the thing that they focus on, not the fact that, hey, performance is great. We'll get that solved today, right? But I would say it all comes back to, asking your manager, like understand their processes, right? What softwares do they use? What is their philosophy? And that's probably a good point to jump into of like how we look at real estate. I would say there's 2 camps of thought with operational philosophy where there's loss to vacancy, very easy concept. The unit's empty. It's not renting. I'm losing money. What's very often overlooked is loss to lease, right? Opportunity cost, where sure, the building's full, but undervalue, right? Okay. And so the bigger loss long-term is loss to lease, because if I have, let's say, a 4-unit that's doing $1,000, it's full. Okay, in the short term, somebody moves out. I'm losing $1,000. But if the value of those units is $1,500, let's say, you're really losing $2,000, right? You're losing 50% every single month. So by the point you rent out that first $1,500, That second 1,500, well, now you're doing 3,000. So you've covered 50%. So you could have one vacancy forever because you're doing 100% of the income based off 3 units compared to what you were doing with 4. And then scale that, right? So when you get a 200 unit complex, that's the value add strategy in a nutshell, right? So when you can scale up and have every single unit, it's, let's say roughly in the markets we've been buying in, you see that, rent achieved compared to market, especially with inflation, is probably 20 to 40%, right? But back to the point of like, when you look on the market, there's that 30 to 40% gap.
Mm-hmm.
And so if there's 20 to 40% upside there, let's say at least every 5 units, right? When you update 5 units to market, you're gaining a unit. So if you have 50 units, by the time you're done, you've just added 10 units, right? So you just added 20% in income. So you could, in theory, have 10 vacant units always, and you're still achieving the same level of operation financially as you were at 100% capacity. And so that's where, when we get these properties to this point, and typically it's not fast, right? You're not going to snap your fingers and it's next month.
Everybody out, we're getting new ones in at this moment, right?
We do have some clients that do that, and they have been successful with it. And even if they're that fast, it's like 6 months, right? Where it's day one, everyone's month to month, send them the renewal to this level. We had a client do that. He had 8 units in Fort Atkinson, and great. This guy is great at what he does. He's got a great eye for it, got a great mind for it, and also just has a brass pair, right?
All right.
So, because like we look at him, we're like, that's brave, because maybe we don't know the market well enough.
So he goes in there just guns blazing. Everybody, this is what it's going to be.
Yeah, and so like this one specifically, I think it was like roughly $800 average rents. 8 unit, it was 3-bed, 2-bath, 2-bed, 2-bath townhomes, 2-car garage, right? So like very nice units. Mm-hmm. And market rate for those was, if we look out at what we can get for them as they move out, $1,600.
Oh, and they're at $800.
So they just found a deal where the property was just significantly under market. And it was, somebody owned it for 30, 40, 50 years. They had it free and clear. They didn't care, right? Mm-hmm. And not that they don't care, but they're like, I just don't believe you that you can get that level of rent, right? And so he went through day one. He's like, all right, I'm going to raise it to $1,400. So there's still a $200 gap, because all of those people, if they did look in market to get the same unit they're paying for currently, they would be paying $200 more than what was being asked. And so that's one of the things that, we have these conversations with tenants oftentimes, and people ask, like, how can you justify raising rent on people? And it's less of we're taking advantage of anybody and more of they've been getting a really good deal for a long time.
Yeah.
Right.
This is the market.
Yeah. And so that's, for us, we're just correcting to the market, because ultimately, side tangent, if everything's corrected to the market, now you drive further investment, right? So you now get developers that will come in. So if we live in some prairie, Wanakee, and we're like, I love Chick-fil-A to come. Well, Chick-fil-A is not going to come unless, all of these rents are getting up. There's new apartments being built. There's new development, new jobs, all of that, right? So it's, I get asked the question, it's like, is it chicken or the egg? Do the rents have to go up, or do the jobs have to come in first, right? Or, it's tough to say. But I think that, back to the Fort Atkinson model, and back to the, kind of lost to lease and lost to vacancy concept, is this client was well aware. He's like, I assume half of these people are going to leave, right?
Sure.
The wild thing is not a single one left, right? So
they knew.
Yeah, they all knew.
Or they were able to afford it. And
yeah. And so, and they, they're all paying. They're all happy to be there. And like one of the things, like he's like, day one, I, resealed the parking lot, fixed the garbage around, told everybody if there's any problems whatsoever, work order wise, let us know, right? We'll get it taken care of.
So that's the cool thing, right? Because now you have more cash to actually fix this stuff instead of being like, we're upside down again.
Oh, yeah.
I don't care if the parking lot's cracked because we can't afford to live.
Oh, yeah. Well, so he's, that property specifically bought the valuation at, the rents are $800. The bank is telling me that this is worth X, so it's worth X. Well, he doubled the rent, doubled the value. Well, now he's cash flowing twice as much, so he can aggressively go back and give everybody more, right? So that's, especially at scale, like that kind of goes back to the amenitization point of like the 200 unit complexes we do, where, like Canterbury and Sun Prairie is a good example. Is we have this 136 units and there wasn't a gym, but people are paying enough we can put the gym in, right? We can put in these common picnic spaces, patio spaces. How do we make this a more livable community? And can you continue to do so over time? And like, we'll ask people, what are the things they want to see, right? And I'd say fitness spaces and dog parks are like the two leading, requests.
You're talking dog park at an apartment complex?
Yeah. Oh yeah. Call it as simple as like black chain link fence, right?
Okay.
You throw, could be a couple 100 square feet, could be an acre, right?
Okay.
Depending on how big you want to go. But in today's world, actually after COVID, and this is an interesting stat that we've learned recently because of COVID. So before, the average renter, it was about 40% of the market had pets. After COVID, it's about 80%, right?
80 versus 40.
Oh yeah, and we saw this. We saw it up in Toma first because we had a couple of buildings that were strictly no pets. Obviously, like ESA if they have them, but we're doing no pets, and like we hit this wall, and like nothing changed. We didn't change pricing, we didn't change promo, but like we just could not rent anything, and we're like, well, let's flip the switch, let pets come in overnight, filled, right? And it was again because of COVID, like people just started. They're like, I'm staying home, I want my pet, whatever the case was, right? So yeah, we saw that population boom, and obviously you charge for the pets, you can get whatever $40 per pet, so there is an additional source there. So ironically, we see monthly charges as an additional income stream for like the pets specifically, not fees, but like that's become significant enough that on these 136 unit properties, it's almost the equivalent of 2 to 5 units worth of income.
Oh wow!
Just because people have pets, and
so you're talking like carpet replacement and all the stuff from the damage of the pets.
Yeah, so they'll still have a deposit, but like one of the things, kind of back to philosophical, is we hate carpet, right?
Okay.
And so we do tons of flooring, and so like we do our own contracting for flooring. We probably did a couple 100,000 square feet of flooring across all of our properties last year.
Wow.
And so generally every time, so like Canterbury especially, we have kind of like a phase model. So phase 1, 2, 3, 4 for updating units. So typically we're not like, okay, this unit's open, we're going to do new floor paint, got the kitchen, got the bathroom, it's do some of it, right? And the biggest ROI is new floor and paint. And so we've taken all the carpet out everywhere we can. Sometimes if it's an older building and you have to have it for sound dampening, we might throw carpet. We always segregate the carpet so that way it's split by a hallway, so you don't have to color match, right? And so each bedroom is individually its own carpeted area. And then if the living room is high traffic and there's poor insulation, then we'll do that. But now you end up with, let's say, a 2-bedroom unit. You have living room, bedroom 1, bedroom 2, so those 3 spaces. Everything else is LVP. So as far as turn time, if you only have to do 1 room, you can rip that out, get it in pretty quickly. In theory, if a tenant was like, this is, for whatever reason, I need this replaced, all right, move all your stuff to bedroom 2, we'll get bedroom 1 swapped. It gives you some flexibility. But generally speaking, if we can get away with 100% LVP, people will buy their own rugs, right? TJ Maxx, Marshalls, they've got it figured out, right?
Okay, yeah.
And so and like that also gives people the sentiment of like, this unit is cleaner, right? Because you're not living in somebody else's carpet, right?
Oh, it's like some filter.
Well, it's
just standing on a filter.
Oh yeah, you rip it up and there's mountains of sand and whatever else. It's so hard to keep clean, right? And so allergies, all of that stuff, we see that positive response. And so I think that's a huge piece in today's world, that the renter highly values that hard surface floor, whether it's tile, whether it's LVP. But I would say that's a big thing that we've learned over time that's been a huge value add.
All right, interesting. Chris, has been cool. I learned a lot. I do, just really quick before we go, I'm landlord. I hire you. Mm-hmm. Am I getting a monthly? Hey, this is how things are going, a weekly, a daily, an hourly, a yearly?
Yeah, so one of the things that's interesting about how we set up versus what's kind of been conventional too is, again, back to because technology has grown, you own the bank account, right? So it's your bank account tied to your EIN for the property, and you have access to that 100% of the time. So if you want to pull out owner distribution, you don't have to tell us what it's for. We'll see it in the monthly reconciliation and we'll book it that way. We'll ask, hey, do you want to let us know what it is? We can put it under, oh, you bought a hot water heater, right? Or you went on vacation. Either way, who cares, right? It's your money to use as you want. And so we have the monthly reconciliation. So all of the incomes, all of the expenses, all of our clients get an automatic, roughly around the 15th. That they're all reconciled. Here is the statement. And so that's where we've been trending toward our preferences. If we can have everything in-house, mortgage, insurance, taxes, then at the end of the year, you have this, annual cash flow statement, income and expense for this property. It's 100%, right? There's nothing outside of this, like, oh, you were paying your own insurance, so you got to tell your accountant that. So that's been, a huge intangible value. And then for us, it also helps us understand cash flow position of the client better, because it's not, well, what is your mortgage? What is your insurance? What are your taxes, right? We don't know these numbers, so we don't know how we can help you solve for, is there a cash flow issue? Well, we're giving you a big check every month. We don't know how much of that you get to keep, right? So there's a value for us to be able to know that and, participate and give advice because of, just knowing that data. And so again, clients have the ability, they let us know what they want to do. So at any point, we have some clients where, again, we don't talk to them all year. They get their, monthly distributions. If the building's full, all is going well, there's not necessarily a reason to talk. But we have some clients, like one of our guys has a 4-unit, had a vacant unit, and then got notice on 2 of them, just happenstance, right? Lease is timed up. And so he's like, I'm going to end up with 3 vacant units. And so we're like, well, let's have a weekly call, as we go through this process, to give you transparency, to give you comfort, communication, have you involved in what can we do as far as pricing levers. Well, let's shoot for the moon on this one because we updated it and we've got a little bit of time. Next week, we'll drop it down 100, drop it down 200, and kind of have those conversations. So I would say we've gotten to be better at kind of a la carte and customization, because we've been building the team out. So we've got a dedicated director of client relations now. So he is kind of main point of contact for all of our clients. So it's no longer, back in the day, we'd be like, here's the email for the finance team. Here's the email for the maintenance team. Here's the email for this, right?
Gotcha.
So
Okay.
We've done a good job of intentionally streamlining that. And, our intention is to make that more robust in the future. But I would say that's, as far as from the landlord talking to us as the manager, transparency is, our number one goal, right? We want to make sure what's happening. There's never any unreasonable expectations. And we are very candid, where we'll tell people, like we have some clients that they're like, hey, I want to price at this level and I want to get, this level of applicant, credit score needs to be this much. And we'll tell them, we actually saw one that we were, our client's buying the property because the seller has a lot of vacancy and their criteria was 700 credit score and double deposits. And we're like, well, that's an extremely highly qualified person. And again, this product was like 1970s vintage. We're like, you don't get to demand that, right, for this. It's just simply...
You can ask for it. You may not get it.
Yeah. Well, and that's the problem. We're like, why aren't we renting anything? And it's like, well, here are the levers, right? So maybe adjust. And so, I'd say ultimately it all comes back to just that communication, expectations, and, trying to drive that point as, kind of our main goal with our clients. Gotcha.
Cool. Chris, where can people find you online?
We've patriot-properties.com. That's our company website. We have on that website all of our Instagram, Facebook handles. Those are on there. I'm terrible. I don't know know them offhand.
Nah, it's all good.
I also don't exist online. I had to get rid of Instagram. It's too addicting for me.
Oh, it's like crack.
Yeah.
It's
walk
tough.
Away. Yeah. So, but yeah, find us on Patriot-Properties is the best spot. And we do have a page that, we have a team that manages LinkedIn and all of that. And so you kind of see some of our clients that post a lot will repost and kind of show that that network that we have, highlighting some of the stuff that some of our clients are doing that, is in a cool way.
Nice. I love it. This has been Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. We are locally underwritten by the Bank of Sun Prairie. If you are listening or watching this on the web, if you could do us a huge favor, help the algorithm out, and that helps us out. Give us a big old thumbs up, subscribe, and of course, share it with your entrepreneurial friends, especially those friends that may be interested in getting into the real estate game, or they are in the real estate game, and they need a better property manager. Chris is your man. We'd like to thank your wonderful listeners, as well as our guest, Chris Gantz of Patriot Properties. Chris, can you tell us that website one more time?
Patriot-properties.com.
Easy enough. Past episodes can be found morning, noon, and night at the podcast link found at drawincustomers.com. Thank you for joining us. We will see you next week. I want you to stay awesome. And if you do nothing else, enjoy your business. And Authentic Business Adventures is brought to you by Calls on Call, offering call answering and receptionist services for service businesses across the country on the web at callsoncall.com. And of course, the Bold Business Book, a book for the entrepreneur and all of us, available wherever fine books are sold.